Disclaimer: this video is for educational and informational purposes only. The content shared does not constitute financial, investment, or trading advice. There's a trade that's supposed to work. It's one of the oldest, most reliable arbitrage strategies in commodities. You buy silver on one exchange where it's cheap, you sell it on another where it's expensive, you pocket the difference, and the gap closes. It's textbook market efficiency. It's how markets are supposed to self-correct. And right now, it's not working. The trade that should close the gap between COMEX and Shanghai is breaking down. And what that breakdown tells us is more important than the price divergence itself. If you've been following the silver market over the past year or so, you've heard me talk about the Shanghai premium, the fact that silver is trading at a persistent and growing premium on the Shanghai Futures Exchange compared to COMEX. At times, that premium has exceeded $20 per kilogram. That's not a currency effect, that's not shipping costs, that's structural demand outstripping structural supply in one of the world's largest economies. But here's what I want to walk you through today. It's not just that the premium exists, it's that the arbitrage mechanism that's supposed to eliminate it is broken. And understanding why it's broken tells you everything you need to know about where the physical silver market is actually headed. Let me set up the trade first, because if you don't understand how it's supposed to work, you can't understand why it's failing. The COMEX silver price in New York is currently trading at, let's say, $30 per troy ounce. At the same moment, the Shanghai Futures Exchange is pricing silver at 250 yuan per kilogram. You convert that using the current exchange rate. You adjust for transportation costs, you adjust for VAT taxes on imports into China, you adjust for insurance and handling, and theoretically, you should land very close to $30 per ounce. Maybe 28, maybe 32, but within a reasonable margin. That's the baseline. That's what efficiency looks like. Now, if Shanghai suddenly shoots to 270 yuan per kilogram, while COMEX stays at $30, you have a gap, a profit opportunity. Here's the trade. You go to a COMEX-approved vault. You buy 1 million ounces of silver at $30 per ounce. That costs you $30 million. You arrange for that silver to be shipped to Shanghai. You pay the transportation costs, maybe $2 per ounce. You pay the VAT, roughly 13% on the landed cost, which adds another $4 per ounce. You pay insurance and handling, maybe another 50 cents, so your all-in cost is roughly $36.50 per ounce. You then sell that silver on the Shanghai Exchange at the equivalent of $38 per ounce. You pocket $1.50 per ounce on 1 million ounces. That's $1.5 million of profit. For a trade that takes a few weeks, that's a solid return. And here's the thing, once you execute that trade, you've just bought silver from COMEX vaults and sold it into Shanghai. You've reduced supply on the COMEX side and increased supply on the Shanghai side. That pushes COMEX prices up and Shanghai prices down. The gap narrows. That's how markets work. That's how they self-correct. Except it's not happening. Not at the scale needed. Not with the consistency needed. The gap keeps opening back up. So the question is, why? Why isn't this trade working? Why can arbitrage desks, with unlimited capital, with sophisticated logistics networks, with real-time price feeds, not simply execute this trade at a scale large enough to close the gap? And the answer is not one thing. It's multiple barriers, some regulatory, some logistical, some financial, all converging to break down what should be an unstoppable profit opportunity. Let's start with the regulatory barrier. This is the one that surprises most people because they assume markets are frictionless. They're not. China has export controls on precious metals. You can't just move silver out of China freely. It goes both ways. There are limits on how much physical silver can cross the border in either direction per month. There are licensing requirements. There are bureaucratic processes. These exist for policy reasons. China wants to manage its precious metal supply. It wants to prevent capital flight through precious metals. It wants to manage its currency and its reserves. So even if the arbitrage is wildly profitable, even if you have 1 million ounces sitting in Shanghai ready to sell, if you don't have the regulatory allocation to move it to COMEX, you can't execute the trade. This is not speculation. This is documented. Precious metals traders have repeatedly cited regulatory constraints as the reason they can't move metal fast enough to close price gaps. It's not that they don't want to, it's not that they haven't tried, it's that the system has a maximum diameter for how much metal can flow across borders, and that diameter is smaller than the demand gap requires. Second barrier, logistics. Moving 1 million ounces of silver across an ocean is not trivial. You need specialized shipping, you need security, you need insurance. You need vaults on both ends that are COMEX approved or SHFE approved respectively. That approvals process takes time. Some vaults are at capacity, some have restricted intake. If you're trying to move metal at speed, if you're competing with dozens of other arbitrage traders trying to do the same thing, you hit logistical queues. That adds time and cost. It eats into the profit margin. A gap that's profitable at $2 per ounce becomes unprofitable when logistics costs balloon to $2.50. Third barrier, and this is the one that I think is most underappreciated. Not all silver in the COMEX inventory is actually available. Remember when I talked about registered versus eligible silver? Registered silver is metal that's been officially warranted for delivery. But eligible silver, that's metal in COMEX vaults that hasn't been warranted. It belongs to someone. An ETF, an industrial company, a central bank. That owner could warrant it tomorrow, converting it to registered status. Or they might hold it indefinitely. But here's the key. Just because metal is sitting in a COMEX vault doesn't mean it's for sale. The owner might have a strategic hold. They might be accumulating. They might be hedging a liability. The metal might be spoken for by obligations you can't see in the inventory number. So when an arbitrage trader looks at the COMEX inventory report and sees 150 million ounces, they might think, okay, I can source 1 million ounces for my trade. But if 70 million of those ounces are eligible metal that the owners won't release, and 30 million are registered metal that's committed to other purposes, they might only be able to source 5 million. That creates a bottleneck. The available supply is much smaller than the headline number implies. Fourth barrier, price impact. This one is subtle but important. If you're going to arbitrage this trade at scale, if you're going to move millions of ounces, you can't do it invisibly. As you're buying on COMEX, you're bidding up the price. As you're selling on Shanghai, you're pushing the price down. You're creating slippage. A gap that looked profitable at the start of the trade might not be by the time you've moved half the metal. And if other traders are trying to do the same trade simultaneously, you're all competing for the same finite inventory on the buy side and pushing into the same finite demand on the sell side. Fifth barrier, financing and time value. Moving silver takes weeks. You're tying up capital for weeks while the metal is in transit. You're paying carrying costs, storage costs, insurance costs that accrue daily. The longer the trade takes, the more those costs eat into your profit. And if you're financing this with borrowed capital, interest charges apply. A trade that looks profitable, assuming a 2-week transit time, becomes unprofitable if logistics delays push it to 4 weeks. Sixth barrier, and this is important, delivery mechanics. Even if you solve all the other problems, even if you source the metal, move it, and sell it on Shanghai, you still have to take delivery on the sell side and pay for it. Shanghai delivery operates on a contract cycle. There are specific delivery months. If you're caught between delivery cycles, you're rolling positions, paying roll costs, incurring financing charges. The mechanics of how futures contracts settle creates friction that arbitrage has to overcome. Now here's where this gets really important for understanding the silver market. All of these barriers exist in both directions. It's not just hard to arbitrage from COMEX to Shanghai. It's also hard to arbitrage from Shanghai back to COMEX. So you have what's called a two-way bid-ask spread. On the COMEX side, arbitrage traders would like to buy cheaper metal and export it to Shanghai. On the Shanghai side, they'd like to buy cheaper metal and export it to COMEX. But the barriers prevent both sides from executing at scale. The barriers create a dead zone in the middle where the gap can persist without being arbitraged away. And that dead zone is expanding. The gap between COMEX and Shanghai is not closing, it's widening. It persists, it spikes, it eases, but it doesn't resolve. That tells you something fundamental. It tells you that the regulatory, logistical, and financial barriers to arbitrage are becoming more binding than the price incentive to trade. In other words, the gap could be $3 per ounce, and traders still couldn't profitably execute the arbitrage because the barriers are so binding. When that happens, when arbitrage breaks down, it means the two prices are no longer really linked. They're not determined by the same marginal buyer anymore. They're determined by different supply-demand conditions specific to each market. COMEX is being set by Western institutional traders, speculators, and some industrial hedging. Shanghai is being set by Chinese industrial demand, Chinese retail investment demand, and Chinese policy. Those two things are no longer talking to each other in real time. They're operating in different universes. And when you have two prices for the same commodity operating in different universes, that's a signal of structural tightness. It's a signal that one market is materially constrained relative to the other. In this case, Shanghai is constrained. Chinese demand is so high, Chinese supply is so low, Chinese investors are so desperate for silver exposure that the price is being pushed higher than the Western market can rationalize. The Western market looks at the Shanghai price and says, that's too high, arbitrage should fix it. But arbitrage can't fix it because the barriers are too binding, so Shanghai prices stay high. And every time they stay high, every time the gap persists, you get confirmation that the physical demand on that side is genuinely intense. Now let me talk about what happens when arbitrage breaks down. History provides some examples. In the 1970s, when silver prices were surging and the physical market was tight, the spread between spot and forward prices blew out to levels that made no sense on a fundamental basis. Arbitrage couldn't close it because the physical constraints were too binding. Eventually, the system cracked. There was a delivery squeeze. Prices spiked. Volatility exploded. That's what happens when you have two markets for the same commodity and arbitrage can't link them. More recently, in the gold market, we've seen similar dynamics. When the physical gold market is tight, when central banks are buying, when Indian demand is surging, the gold forward basis, which measures the gap between spot and forward prices, compresses or even inverts. That's a signal of physical scarcity. Arbitrage can't close the gap because the physical market is too tight. The same thing is happening with silver right now, except it's playing out across two global exchanges in real time with a persistently widening gap. The reason this matters is that it's telling you something about future price discovery. Right now, most people look at the COMEX price as the true price of silver. Everything else is noise. But if COMEX is increasingly detached from the physical market, if Shanghai is the true price of physical silver, and COMEX is a derivative of that, then COMEX prices are lagging. They're lagging the physical reality. At some point, that lag gets corrected. And the correction tends to be painful for people on the wrong side of it. Here's what I expect to happen. I don't know the timing, I'm not a fortune teller, but the structure suggests that either COMEX prices are going to rise sharply to match Shanghai, or Shanghai prices are going to fall to match COMEX. Given that Shanghai is being driven by real demand and COMEX is being driven by speculators and institutional positioning, I think the move is much more likely to be COMEX rising. But either way, the gap closing is going to involve volatility. For investors sitting in silver, this arbitrage breakdown is actually bullish. It means Shanghai holders are paying a massive premium for the metal because they genuinely value it. It means they're not going to sell into the gap. They're going to hold. That supply is off the market. That demand is structural. And when COMEX finally reprices to match Shanghai, when the gap closes, it's going to be painful for anyone short or underweighted on the physical side. What I'd be watching for is any sign that the regulatory barriers are easing, that logistics is improving, or that financing costs are coming down. If arbitrage suddenly becomes viable again, if traders can profitably move metal from COMEX to Shanghai at scale, you'll see an acceleration in the gap closure. That might actually be a signal to take profits if you're long. Conversely, if the barriers get more binding, if regulations tighten, if logistics get worse, the gap will widen further. That's a signal that physical constraints are intensifying. The bottom line is this. The arbitrage that's supposed to link COMEX and Shanghai is broken. It's broken because the barriers to executing it are too high relative to the profit opportunity. And that breakdown is telling you that the two markets are operating under fundamentally different supply-demand conditions. Shanghai is tight, COMEX is loose. Eventually, those two realities have to converge, and when they do, the move is going to matter. Stay informed, watch the gap, and understand that when arbitrage breaks down, volatility usually follows. Thanks for watching.